touching on some topics on international flow of funds. And I believe you had very interesting perspectives from your colleagues. And I'm hoping that should have enriched your understanding of the issues that we discussed last week.
So I can increase the materials and my prices.
Okay, so let's start with today's topic, financial markets, international financial markets. I'll begin with the foreign exchange market. I am going to ask you to read on the money market, the credit market, the bonds market, and the stock market. These ones are very familiar to you, and you must have gone through them in corporate finance. Okay, so we will spend our time on the foreign exchange market, but nonetheless, you should still try and read on this. If you have any issues, you can ask me directly, or when we come to class, you can bring it up. We can resolve it for you. The foreign exchange market allows for the exchange of one currency for another. Okay, the platform, the arrangement that allows participants, that is individuals, multinational corporations, and governments, to exchange one currency for another currency is what you call the foreign exchange market. So it's not necessarily a place. Okay, it's just the arrangement that allows that to happen. So generally in economics and finance, when we say market, we are not necessarily referring to a particular location or a geographical location where trading activities take place, but we are referring to the arrangement that allows the exchange or the interaction between buyers and sellers of a particular asset or commodity. Okay, so the foreign exchange market is important not just for multinational corporations, but individuals as well. The main players or custodians of the foreign currency in the market is the commercial banks. Okay, commercial banks serve this market by holding inventory of each currency so that they can accommodate requests by individuals. Okay, so they must hold a minimum amount of each currency such that when a request is made by individuals or multinational corporations, they will be able to meet that request. For instance, if they don't hold inventory of dollars, when you go there to buy dollars, you won't have it from them. If they don't hold cedis, if you go there to buy cedis with your dollars, you will not be able to do so. So they must hold an inventory of the major currencies that are traded with within the area that they are situated. So commercial banks are very important in the foreign exchange market. Like I said earlier, individuals rely on the foreign exchange market when they travel. Okay, so when they travel or when they are traveling to foreign countries, they will need the currency of that currency or a currency that can easily be converted to the local currency of that country. For instance, if you are traveling to Venezuela, you might not find their currency, okay, to buy in Ghana. But you also know that there might not be an active foreign exchange market for the Ghana cedi in that country. So if you travel to Venezuela with your Ghana cedi, you might not be able to find buyers of it, or you won't be able to sell it for the local currency of Venezuela. So what they usually do, or what individuals would do, is to buy a currency that can be accepted, that can be sold in the country where you are going to. Okay, so globally, the US dollar is becoming, or has become, the currency for the global market. So if you travel to any country and you have the US dollars, you can easily sell it for the local currency of that country. That's why when people are traveling, they are looking for dollars to buy. Okay, so good. Now, the exchange rate is the rate at which one currency can be exchanged for another. Okay, if you want to sell your dollars, there must be a price that you charge or that is paid to you. Okay, that price is what you call the exchange rate. Okay, the rate specifies the rate of exchange of one country for another. In other words, it is the price of one currency in terms of the other currency. Okay, so the Ghana cedi, the US dollar is currently selling at what price? Who has the latest figure for me?
I think it's supposed to be 50.
Is what?
7 cities 50.
8 cedis.
7 cities 52 pesos.
7 cedis, 15 pesos. What's the average price in the market?
8 cedi 10.
Please, let me hear you well. Position yourself well. Okay. Some sell it at 7 cedis, 75 pesos. Others sell it at 8 cedis, 15 pesos. So it varies. Okay. It varies. Let's see our neighbors, Fidelity Bank. How much are they selling the US dollar today? Okay, I'm not sure. Let me share it. Yeah, so this Fidelity Bank, I'm sure you can see. So let's see. Yes, so that's today's Forex. So you see there are two, buying and selling. We'll come and explain that later. Okay, one is 7.23, the other is what? 7.75 for the US dollar. Let's see what, let's say ADB Bank, ADB. Let's see what their Forex rates are. It's one private bank. Forex. I'm sure it will be somewhere here. Yes, so it's here. Forex rate. The US dollar, ADB is buying at 7 cedis, 10 pesos, 7 cedis, 90 pesos for online transactions. Okay, if you are doing a transfer, you are making payments abroad or paying to someone. But if you want the physical dollar, they are selling it at 8 cedis, 15 pesos. Okay. So there are price variations in the market.
Okay.
So that's the exchange rate, the price of one currency in terms of another. Now, we can't discuss the exchange rate market without first going through the history. In other words, the system that we use to regulate or to guide the exchange of one currency for another didn't start with the current system that we have. Okay, it began some long time ago with different systems in place. And then now we have the current system. So somewhere in 1876, the gold standard was introduced, where each currency was convertible into gold at a specified rate. For instance, if 1 unit of your cedi or 1 ounce of gold is 5 cedis, for instance, and you want to buy the US dollar, you wanted the US dollar, there was no exchange rate between the Ghana cedi and the US dollar. You had to convert your cedis to gold, meaning you have to use your cedi to buy gold, and then that gold is sold for US dollars. Okay, so there was an exchange rate, there was a price of gold in cedis and a price of gold in dollars. So if you want dollars, buy the gold with your cedis and then sell it for dollars. So the gold became the medium of exchange of one currency for another currency. I don't know whether you understand what we are saying here.
Okay.
Okay, so yes, go ahead.
Please come again with that point.
The point is that there was no exchange rate between the dollar and the cedi, but there was a price of gold in dollars. There was a price of gold also in cedis. So if you want to have dollars and you have cedis, you have to go through the gold, buy the gold with your cedis, and then sell the gold for US dollars. So each currency was backed by gold. Okay. For instance, 1 cedi is worth 1 ounce of gold, but maybe 10 cents is worth 1 ounce of gold. So you have to use your 1 cedi to buy the gold, and then you sell the gold for the US dollars. So the gold was the standard for exchanging one currency for another. And that's what the gold standard is about.
Okay, thank you.
All right. Okay. But when the World War started in 1914, the gold standard was suspended. Okay. It was suspended. And you know the effects of wars. Now, some countries attempted to peg their currencies to the dollar. We'll talk about pegged exchange rate system later. Okay. After the suspension of the gold standard, but all those ones had issues. So somewhere in 1944, some agreements were reached by Bretton Woods institutions or countries in the region. Okay, and they called that the Bretton Woods Agreement. And they called for a fixed exchange rate to exist between currencies. Okay. For instance, government says $1 is 5 cedis. So it becomes illegal to sell at a price higher than the 5 cedis, and also illegal to sell at a price lower than the 5 cedis. But with the Bretton Woods Agreement, they allowed some flexibility, one plus or minus 1%, which means that if the price of $1 is 5 cedis, it can increase up to a maximum of plus 1%. So let's see, 1% of 5 cedis is what? Yes, who can give me the answer?
0.05.
0.05.
Yeah.
So subtract 0.05 from 5 cedis, you get 4 cedis, 95 pesos. And that was the minimum it could go below. And then add 0.05 to 5 cedis, and that gives you 5 cedis, 5 pesos. So the currency prices could fluctuate between these two boundaries, plus or minus 1% of what the government has announced. But anything beyond that or below that becomes illegal. So, under such a circumstance, when it becomes necessary for currency prices to increase beyond that percentage because of higher demand, government will have to come in and supply the excess just to ensure that the currency remains within that boundary and activities of black market does not lead to undesirable effects. Also, when the supply is more than enough, and then it becomes necessary for currency prices to fall below the minimum boundary, government will have to come in and buy the excess just to ensure that it stays within that fixed rate. So it happens to the Smithsonian Agreement as well, but the only difference is that in this case, the fixed rate, the room for flexibility was expanded. Okay, it was increased to plus or minus 2.25%. So that allowed more freedom for flexibility in the prices of foreign currency, but that was still not enough. Okay, so these agreements were prominent in propagating the fixed exchange rate regimes in the past, and this also lasted until 1973, not for long.
Hello.
When, yes, go ahead.
Okay, so under the Smithsonian Agreement, so that one to meaning the price cannot go above the 2.25.
Yes. Okay, so if you take 2.25% of 5 cities, okay, so and you add it to the 5 cities, that becomes the upper bound. And then you subtract it from 5 cities, that becomes the minimum bound. Okay, so fixed exchange rate regime allows some room for flexibility, but it doesn't, the flexibility is not that much.
Okay.
Yes, Andy. Carl. It's Carl, rather.
Yeah. So I wanted you to explain the situation where the government comes intervenes to balance the
For instance,
rates.
if government says don't sell below 4 cedis 95 pesos and don't sell above 5 cedis 5 pesos, but the demand for the dollar is so huge that it's not even there for people to buy. You know, when something is in scarce, the price goes up automatically. Market forces will push the prices up. Now, but here's the case, government says nobody should sell above that price. Selling above it becomes illegal. So what do? You will see people hold on to it, and then others will even offer to buy it off the market. That's what we call the black market activity. For instance, I have the dollar and I'm not selling because I feel the price the government is quoting is too low, given the fact that there's so much demand for it. So I can say I'm not selling, but somebody will come behind the scenes and tell you, you know what, me, I'm willing to buy it at a price higher than what the government is saying, but let's keep it to ourselves. Okay, so that will force prices up. I'm sure you know about price ceilings. You did that in microeconomics. Price ceilings and price floors, maximum price and minimum price regulations. So if government doesn't come in and supply the foreign currency just to meet the growing demand, then eventually the activities of the black market will force the prices to increase off the formal sector, meaning at the blind side of the government. And that means that the regulation becomes very weak and you will not be able to achieve the objective that you wanted to achieve. So government must come in to supply the excess just to keep it at that fixed boundary. And also when supply is more than the demand, prices must fall. The price of the foreign currency must fall. Okay, but if government doesn't want it to fall below the lower bound, they have to come in and buy the excess from the market just to ensure that it stays within the fixed boundary. Okay. Then we have the floating exchange rate system. And this system allows for total fluctuation. Okay, it allows the market to freely determine the prices of foreign currencies. Okay, so currencies are traded and they are allowed to fluctuate in accordance with the market forces. So government hand is tied here. Okay, they allow the market to determine the price for each currency. So if the demand for the dollar is growing, then the price of the dollar is also growing. But if the demand for the dollar is falling, then the price of the dollar falls. Okay, so no announcement is made specifying boundaries, okay, and directing people to abide by it. Here, the market forces freely determine the prices of the foreign currency. So this came into effect somewhere in 1973. You can read more on this from Jeff Madura, the book I shared with you. So there are no official boundaries set by government, but that doesn't mean that government cannot sometimes come in. But we will discuss exchange rate systems later. But this is just the history of it, where we came from. So now let's look at foreign exchange transactions. Like I said, the foreign exchange market should not be thought of as a specific building or location where you can go and buy currencies or sell currencies. Okay, so corporations or multinational corporations would normally exchange one currency for another through a commercial bank. Okay, and it is usually done over a telecommunications network. Okay, and what does it mean? You don't necessarily have to go and tell the bank that I want dollars to buy. Maybe the bank that can supply the dollars you want is not in Ghana, or the banks in Ghana don't have the dollars to sell to you. So they will have to make a request also from other institutions. We call them dealers, other dealers across the world who have the foreign currency. And it is done through that telecommunications network. We'll come back and discuss these payment systems later. Okay, so we're not going to waste time here. So what matters is that it's not a specific place where you go and buy. Okay, you can buy through an online platform. Okay, can buy through an online platform. That's what Okay, so the dealers serve as intermediaries in the foreign exchange market. Like I said, commercial banks and other dealers who are not necessarily commercial banks are very active in the foreign exchange market. Now, transactions can also be spot transactions or derivative transactions. Okay, spot transactions. Please. Let me mute you so that we can have some peace. So a foreign exchange transaction for immediate exchange is set to trade in the spot market. So the spot market is, I have my dollars, you have your cedis, let's exchange, and the transaction is executed right away. You have your dollars, then I have the cedis, we exchange. Spot market. But it doesn't also mean that you have to meet face to face. Okay, you can do transfer to the person in exchange for the cedis. All right. And now the rate at which currencies are exchanged in the spot market is called the spot rate. Spot rate. So the rates that I showed you earlier from ADB and then from Fidelity Bank, they are spot rates, spot exchange rates. Okay. We also have the derivatives rates. We'll talk about forward rate. We'll talk about futures rate and the rest. We'll come to them later. Now, banks sometimes also trade amongst themselves. Okay, and that trading between banks occurs in the interbank market. And rates in the interbank market are usually lower because these banks will have to also sell them to make margins on them. So the rate at which banks trade among themselves is what they call the interbank rate or interbank forex rate. Now, the US dollar, like I said earlier, is the commonly accepted medium of exchange in the spot market. And it's especially true in countries where the home currency is weak or subject to restrictions. Who can tell me what's the currency of Gambia? We're in Africa. Let's see. What's the currency of Gambia? You are now checking. You don't know.
Dollars.
Yes. Okay. And what's the smaller unit? Eh? All right. Now, if you want to buy it in Ghana, will you get it? Let's say you are traveling to Gambia and you want to buy it in Ghana, will you get it?
No, please.
You will not, okay? But you know for sure that if you travel to the Gambia and you have dollars, you'll be able to sell it for the local currency. And that's why we say the US dollar is the commonly accepted medium of exchange in the spot market. Okay, so in countries where the home currency is weak, when you are traveling there or when you have to travel there, then you have to trade with or you have to look for the US dollar, okay, before you go to those countries. So the dollar is very popular globally. Some countries would even require that you make payments. Let's say if you are in Ghana, you want to make payments abroad, you usually pay in dollars. They quote their prices in dollars to make it easy for you, since there's an active market between the US dollar and your currency, and also their currency and the US dollar. Okay. Now, you can buy anytime within the day, within the week. And the reason is that time zones are different. So if banks in Ghana have closed, multinational corporations can still do transfers because there are banks who are open, there are dealers who are open in other parts of the world. For instance, if I think it's about 9 o'clock, 9:13 in Ghana here, what will be the time in Australia? They are about 12 hours ahead of us. Okay, so add 12 hours. So you see they are already in the next day. All right. So whilst we are sleeping here, somewhere around the world, a bank is operating because that's the working hours for them, and they are ready to accept requests by customers, multinational corporations. Okay, so when you do a transfer, that's why even in the night, when your bank is closed, you can still do a transfer to a foreign country. Okay, you can transfer, you can make payments abroad with your Visa card, you can make payments abroad with your MasterCard, and it's all because when you make a request to make payment in dollars, it goes through stages. It means you are buying the dollars and using it to pay for goods and services. Uh, uh, let's say in China. Okay, there's somebody in China who is selling online, or you are buying a book on Amazon. Okay, online. You go online with your MasterCard, your Visa, and then you click, I want to buy, the book is about $100. Okay, your MasterCard is the account contains CDs, but you are still able to make the payment. Okay, so first of all, you have made a request. When you click on it, it means you have made a request to buy dollars. So there will be a dealer online who wants to accommodate your request. Okay, the person accepts to buy your CDs with dollars and then use the dollars to make payments on your behalf. So that process is what you go through when you make an attempt to make payment online. So there's somewhere, there's a bank online working that time, willing to accept your request and then do the payment on your behalf. Okay, so time zones differences makes it possible for you to execute any transaction at any time within the day, whether it is in the night, when it is 12 a.m. in Ghana, somewhere in the world, there's some bank, financial institution working. And for that matter, they can accept your request. So the spot market is very liquid because there are more buyers and sellers. And it's also liquid because of the differences in time zones. You can always get someone to buy. You can always sell and buy within the spot market. Any questions before we go to attributes of good banks? Any questions?
No, sir.
All right, so move on. Now, if you want to choose a bank, what would you consider before you choose that bank? In other words, you want to decide where to buy your foreign currency. What factors will motivate you to choose bank A over bank B? And these are the factors that we have here. The first one is the competitiveness of the quote. When we say quote, we are referring to the prices that the bank charge for the currencies that you are looking for. How competitive is the quote? In other words, if you compare their prices to other banks, which one is lower? And remember, 1 peso difference means a lot in the foreign exchange market because of the volume of transactions that take place. For instance, if you want to buy $1 million, and as a result of buying from Bank A, you can make a savings of 1 peso on each transaction, on each dollar. How much savings in cedis would you make if you buy the $100 million? Let's say you are making 1 peso. Bank A sells at 8 cedis, 15 pesos, and Bank B sells at 8 cedis, 14 pesos. So let's say with your $1 million, how much would you make? So just multiply the 1 pessoa by the $1 million and see how much you're going to have. How much would it be? 0.01 times 1 million.
$10,000.
$10,000.
So you are making a savings of $10,000. 10,000 cedis, okay, not dollars. 10,000 cedis. And that is a lot. Okay, that is a lot. Okay, so a little difference in the quote of a bank can be a way of attracting customers for that bank. So you can see Fidelity is selling at 7 cedis, 75 pesos. ADB is selling at 8 cedis, 15 pesos. Where would you want to go and buy the dollars? Of course, you want to go to Fidelity Bank so that you can save about 50 pesos on each dollar. Because if Fidelity is 7 cedis, 75 pesos, then ADB is 8 cedis, 15 pesos. Look at the difference. So that's about 40 pesos, right? 40 pesos difference. And multiply it by 1 million, that's a lot of money. About 40,000. Good. Now, the second factor to consider is the special relationship that customers or multinational corporations will have with a bank. So if you have a special relationship with the bank, even if the quote is not as competitive as others, you would still want to trade with them. Okay? Maybe they offer you specialized services for free, which you feel if you are with another bank, you will be paying for. And maybe because of that special relationship, the special services that they offer you, you hold them in high esteem. And for that matter, you wouldn't mind whether their quotes are competitive or not. For example, they may offer you cash management services for free. Or they may even make an attempt. Some currencies are hard to find. For instance, the currency of Zambia. Okay, which country uses kwacha? Is it or kwanza? Which country uses kwanza? Is it Zambia? I think it's Zambia or something. Uganda, right? Yeah, maybe.
I think the Zambian's own is Zambia Kwasha. Something like that.
Okay. Okay. All right. So imagine you want to buy it and your bank says, we'll get it for you. Okay. And they really get it for you. Meanwhile, other banks do not make that extra effort to get you these currencies. You will feel comfortable with that bank, even if their rates are slightly higher. So because of that special relationship, multinational corporations might want to stick to a particular bank, even though their quote may not be as competitive. Then the third reason MNCs might want to stick with a bank is the speed of execution. How fast are they able to execute your transactions for you? If you want to buy the foreign currency, how fast are they able to get it for you? So speed counts in business, and time is money. So they might want to stick with a bank because of the speed of execution. Some banks may also offer advice about current market conditions in foreign lands. Let's say they can tell you about the assessment of foreign economies and the activities in the international financial environment that relate to your business and your customers. Okay, so they can offer you that advice for free, and because of that also, you might want to stick with the bank. Then the last one is the forecasting advice, be able to predict. We think that foreign currency prices will go up. So if you have need for it in the immediate future, why don't you buy it now so that at a future date, when the price goes up, you won't lose. Okay? Or they may tell you if you can wait for 1 more week, you might be able to get it at a lower price, because our forecasting show that foreign currency prices will drop next week. So why don't you wait a little and you will be able to buy at that lower price. So these are the attributes of banks that attract customers to them. Okay. Now, foreign exchange quotations. Let's look at foreign exchange quotations. Okay. How are foreign currency prices quoted? Okay, we saw one earlier and we saw another one with ADB. Now, you need to note that at any given point in time, the quotations are two. We have the bid quote and then the ask quote. The bid quote, or we call it the buy quote, is the price the financial institution or the bank will pay you for the foreign currency. That's the price they buy the foreign currency for whoever brings it to them. Okay, and then we also have the ask quote or the sell quote, and that is the price they will sell it to anyone who comes asking for that foreign currency. So let's get it right. If you have $1 and you want to sell it to Fidelity Bank, okay, you will sell it to them at their bid quote, meaning they will buy it from you at the bid quote. But if you want to buy $1 from them, then they will sell it to you at the ask quote. So let's get it. And we're saying that at any point in time, the bid is lower than the ask because they have to make a margin. If they buy it at 7 cedis, then they might want to add something to it before they sell. And that is what we call the spread. Okay, the bid-ask spread of banks. And it covers the bank's cost of conducting foreign exchange transactions. So they can't do it for free. They incur some costs in doing that. They are paying people. Okay, they are also maintaining inventory. We'll talk about the factors that determine the size of the spread. So the difference between the price they will pay you when you take the dollar there and the price you will pay when you want to buy the dollar is what they call the spread. Okay, the bid-ask spread. You can just see the spread. Now let's look at Exhibit 3. But let's first of all, this is the formula you can use to get the bid-ask spread in percentage terms. Okay, the price they will sell minus the price they will buy divided by the ask rate. Please take note, it is not divided by the bid rate, as you always do in percentage change. This one is not percentage change. Okay, so ask rate minus the bid rate expressed as a percentage of the ask rate. So let's look at this table. So we are taking the US dollar as our global currency, like I said. So we are considering it here as the home currency, the local currency. And now you buy the British pound at 1 cedi. Sorry, the banks buy it at $1.52, but they will sell it at $1.60. So if you want to calculate the bid-ask spread, as the price they sell it, that's the ask rate, minus the price they buy, the bid rate, divided by the ask rate. And then you multiply it by 100%, that gives you 5%. Okay, so the spread is 8 cents But expressed as a percentage, it is 5% of the X rate. The Japanese yen also, you can see it is less than 1 cent. That's the price they buy it. And they also sell it at 0.0074. So if you want to calculate the spread in percentages, find the difference between those, and then you multiply it by 100%. And that's what we have as 5.4%. So the spread is 5% for the British pound, and then it is 5.4% for the US dollar. So we are going back to the exchange rate of Fidelity Bank and ADB to see how we can calculate the spread. Can we all see?
Yes. Yes.
We can all see, right? So I want us to use the cash value. The first one is the US dollar. This is the buying, this is the selling. So the buying is the bid price, and then the selling is the ask price, the bid rate, the ask rate, the bid quote, the ask quote. So I want you to calculate the spread for me. Here, I will go and compare it to the spread of Fidelity Bank also. So let's check, calculate this, the spread.
For the first one.
Yes, for the US dollar, the cash.
Okay.
For the cash transactions, not the transfer transactions.
So I had 0.1288. Hello, sir.
Okay, so who has finished?
So I had 0.1288.
So 0.1288. Who has something different?
So that's 12.89%.
Okay, so you see the spread is very high. Okay, so how did you do it? It is 8.15 minus 7.10 divided by what?
8.15.
Yes, divided by 8.15 times 100%. And then so you have 12.8%, right?
Yes.
All right, that's ADB. Okay, so now let's check Fidelity Bank. Fidelity Bank.
It's not supposed to be times 100%. It's just supposed to be times 100. Yeah, making that mistake.
Who is making the mistake? Hmm?
Okay, it is.
Iram, are we together?
Yes, sir.
You say we are making mistake. What's our mistake?
No, sir, I got it.
Okay, so you were making your mistake. All right, so this is for Fidelity. Let's calculate for Fidelity the spread for the US dollar also.
Hello.
Yes, what do you have?
I had 0.0670, 0.0.
So just tell me in percentages.
Okay.
6.70%.
6.71.
So 6.71%.
Yeah. Percent.
Good. So look at the difference in spread between ADB and Fidelity Bank. So the spread for ADB is 12.8%. And then the spread for Fidelity is almost half of what ADB has. So what accounts for that? Okay, so what factors lead to these differences in spread between banks? So let's go through that. These are the factors. The order costs, the cost of processing orders, including clearing costs and the cost of recording transactions, might differ between these two banks. Okay, so if Fidelity is operationally efficient, maybe because of the systems that they have in place, they will be able to execute transactions at lower costs. And for that matter, they will be able to have a lower spread without losing. Then the second one is the inventory costs. Remember, we said the commercial banks must maintain inventory of every currency just to meet requests by customers. So if the cost of maintaining inventory of a particular currency is very high, then the spread of that currency for each bank is going to be higher than other currencies. You get that?
Yes, sir.
Good. So if the cost of maintaining an inventory, what can you name some of the costs? One is what? The opportunity costs.
Opportunity cost, yeah.
Okay. If I have to keep my dollars, then it means that I'm not getting anything from it. So why would I keep my dollars just waiting for my customers when I could have invested it and made some returns on it? Okay, but if they invest it and people come asking for it, it will not be there. So that cost, that revenue, income, or return that they are losing will have to be incorporated into the spread. Okay, and this differs among currencies and also across banks. And that will explain the differences in spread between one or more banks, and then also between currencies or among currencies. Then the third one is the competition. The more intense the competition, the smaller the spread quoted by intermediaries. This one is straightforward. Okay. In Ghana, the dollar is always in high demand. Okay. And I'm sure we all know the reasons now. Everybody knows why the dollar price keeps going up. Why? Who can give me one reason? You are business students. So why is it that the Ghana cedi or the US dollar is always gaining grounds against the Ghana cedi? It's always increasing in price in terms of the Ghana cedi. Why? I'm sure when you came to level 100, the dollar was not up to 5 cedis. Okay, now you're in 400, the dollar is about 8 cedis. So why? Why is it the case?
Because of high demand. Importation.
High importation.
Yes.
Okay. Why are we importing more?
Because we are not producing more.
Because we are not producing more. That is one. And then what else? Apart from not producing more, why are we importing more?
High taste for foreign.
Good. Because Ghanaians like anything foreign. Okay. Even we like foreigners more than ourselves. Okay. So when two people go to buy something, and then a Ghanaian realizes that this is a foreigner, particularly let's say a white man, they would want to sell or attend to that person faster than you. For whatever reason, we don't know. So we even like foreigners than ourselves. So we like foreign goods. No matter how old it is, we still want to buy it and not the locally made ones. So that's the second reason, high taste for foreign goods, lack of adequate or inadequate production. Then the third one is what? Why we import more. Oh, come on.
Yes.
Test and preference.
Sorry?
Test and preference.
Please, me, I don't like those textbooks terms. So somebody said we have high taste for foreign goods. So why are you saying taste and preference again? Please think on your own. This one, you already
Okay.
get it in the textbook.
I was disconnected, so
Okay.
sorry.
So
I
someone should
didn't hear.
mention another one.
Uh,
Just think. You don't have to be right. If it's wrong, there's nothing wrong with being wrong.
so inadequate industries of some product.
I'm sure it all comes down to low productive capacity. Okay, we are not producing enough.
Yeah.
Oh, come on. I'm sure you know about the fact that locally made goods cost more than the imported ones.
Yeah.
Take rice. You want to get locally made rice of the same quality as, let's say, two products. One is imported, one is made in Ghana. They have the same quality. The made in Ghana one is going to be much more expensive. Okay, so because of these three factors, we import more. But that's not the only reason for which our foreign currency depreciates. Maybe later we will discuss the factors that affect the foreign currency prices, and you'll get it more. Okay, so if competition is intense, the spread is going to be lower because if there's low demand and then there are so many people who are selling, then the competition is going to be intense. Banks will compete to get customers, to get people to buy from them, and then the spread is going to be lower. But if there is no competition, like in Ghana, there's no competition, okay, because the demand for the foreign currencies are high, particularly the US dollar. The demand is very high. So people will always buy. And that's why ADB will have a spread of 12.8%. And they still also sell, despite the fact that the spread is high. They will sell, Fidelity will also sell. They will both make their margins, okay, because the competition is not as intense as we expect. Then the fourth one is the volume. Currencies that have a large trading volume are more liquid, meaning when you buy from someone, you can easily sell it. Okay. In other words, there are numerous buyers and sellers at any given point in time. So if the volume is high and you can turn it around within a short period of time, then you don't lock up your money for a long period of time. So you don't need to charge a very high spread. Okay, so the spread is going to be very small. And even if you are making a little margin, you know you're going to do it a number of times within a day or within a week, and you still make a substantial amount. And that is also one reason for which the spread may be low or high. Volume. Then we have the currency risk. Economic or political conditions that cause the demand for and supply of the currency to change abruptly. For instance, if you have US dollar, let's say you have the Naira, okay? you have the naira, and there's political instability in Nigeria, God forbid, would you want to buy more naira? No, you wouldn't even want to hold it because the risk is that you might not find buyers for it. Okay? As a financial institution, you wouldn't want to hold it because you might not find buyers for it. Okay, so the spread for that currency is going to be very high because the risk is also very high. Or if there's economic recession or depression in a particular country, it means that that country is not going to be selling more. They won't export, or people won't be buying much from that country, so they don't need that country's currency. Okay, so the demand for that currency is going to be very low. So if you do your analysis, your forecast, and then you see that, no, Nigeria is supposed to go, it's likely to go into depression, economic depression, the bank will not hold the currency of Nigeria. So they will charge higher spread on the naira because of the currency risk. So these are the factors that affect the spread, and you need to know them and know how to explain them. Yes.
The currency rates,
Yes.
does it apply to
use
every country? For instance, like US.
Okay.
For instance, with the US dollar, you taking US dollar as an example.
Okay. So what we are saying is that the spread for the US dollar is going to be lower than the spread for the naira. Does it answer your question? Because the economic conditions in the US are better than the economic conditions in Nigeria.
Okay.
Political conditions in the US are better. Do you understand that?
Yes, please.
All right, good. So let's move on. Interpreting foreign exchange quotations. The foreign currency quotations can be presented in two ways. We have what we call the direct quotation, and then we have the indirect quotation. Direct quotation is the value of a foreign currency in terms of a local currency. For instance, in Ghana, let me edit this. This was the price of the dollar last year. I'll edit it so that next year too, I'll show it to them. What's the current price? Average. So let me just say 8 cedis. I'll use ADB's figure. 8 cedis, 50 pesos. 15. Okay. So if $1 is 8 cedis, 15 pesos. In Ghana, we will see this as a direct quotation. Okay. The direct quotation is the value of a foreign currency in terms of a local currency. In other words, number of cedis, the amount of cedis required to buy $1, or one foreign currency is equal to so and so Ghana cedis. When currency exchange rates are stated that way, we refer to it as a direct quotation. The value of a foreign currency in terms of a local currency. But indirect quotation represents the value of a local currency in terms of a foreign currency. In other words, the amount of US dollars required to buy one Ghana cedi. Okay, so let me change this also. So I'm sure you can do the ratio and proportion, but the the formula is that if you want to get the indirect quotation, divide 1 by the direct quotation, and that gives you the indirect quotation. If you also have the indirect quotation and you want to get the direct quotation, divide 1 by the indirect quotation. Okay, the inverse of it. Now, I want you to find the indirect quotation for the 8 cities 15 pesos, so that I'll put it here. Yes, so 1 divided by 8 cities 15 pesos. What do you have?
0.122.
So 0.12. So last year, the CD was worth 17 cents. But this year, the CD is worth 12 cents. So you see, it is going down. So please get this very well. Okay. Direct quotation, value of a foreign currency in terms of a local currency. Indirect quotation is the value of a local currency in terms of foreign currency. So in America, they will see this as the direct quotation.
Yeah.
Okay, because that will be the value of a foreign currency, in that case, which will be the Ghana cedi, in terms of their local currency, which is the US dollar. But in Ghana here, this is our direct quotation. And in the US, this will be indirect quotation. Okay, so you need to know the difference between them. All right, your book is written by an American, so he will always speak from the perspective of an American. Okay, so the examples that you see in the textbook, the US dollar is the local currency there. Okay, so the US dollar is the local currency there. Hello? I can't hear you well, please. Your network. All right, so let's move on. So this is another example. I'm sure we can see. Can we see? Just want to do another example here. Okay, so if the US dollar is worth 8 cedis, 15 pesos, then the indirect quotation, so this is what Ghana cedis. Let me use this for cedis. Ghana cedis per US dollar. So if you want to get the indirect quotation, what figure did you get? 0.1. Give me the figure.
0.12.
0.12, yes, per Ghana cedi. Good. So this is direct quotation for Ghana. We are in Ghana here. And this is indirect quotation. All right, so we can move on.
Hello,
Now,
sir.
yes,
So, in computing this, the direct quotation, that of the indirect, are we
okay.
using is it the bid rate or the ask rate that we are using?
In fact, whichever one, you can find the direct quotation of the bid rate. You can also find the direct quotation for the ask rate. So let's see.
Okay.
Let me just show you fidelity. Look at fidelity. So is this direct quotation or indirect quotation?
Yes.
Who can tell me? These rates.
So this is direct quotation.
Good. So these are direct quotations. USD, the Great British Pound, and the Euro. Okay, this is the price of the foreign currency in terms of the local currency. So this is direct quotation. So this is direct quotation for the bid, and this is direct quotation for the ask. So it doesn't matter whichever rate you have. Okay.
Emma.
Now, so when one currency is appreciating against the other, then it means the other currency is depreciating against it. For instance, if the dollar is appreciating, if the euro is appreciating against the dollar, then it means that the dollar is depreciating against the euro. I think this is straightforward. But the rate of appreciation is not going to be the same as the rate of depreciation. So let's say $1 is 5 cedis last year, and this year $1 is 8 cedis. So what is the rate of appreciation? Okay. But if you want to also find the rate of depreciation of the cedi, then you have to find the value of the cedi in terms of the dollar. That is the indirect quotation. And then you also find the percentage change. So you see they are going to be different. We'll do these things later. Don't worry about that. Now, you can get exchange rate data from so many sources these days. Now, there are even apps on your Play Store or App Store. You can download and it will always give you updates on foreign currency prices. You can visit owando.com or you can even go to Yahoo Finance. There are so many places you can get foreign currency prices. Good. Now, cross exchange rate. Now, if you Google right now, let's do that. Google. So, which country? What's the currency? I want to see the currency of a country that is not even in Africa and that is not so popular. Let me see, Jordan. Currency. Jordan. Okay, so look at this. Jordanian dinar. So it means their currency is even stronger than the US dollar. All right. So one Jordanian dinar is worth 1.41 US dollars. So let me just change this one to cedis. Ghana cedis. So one Jordanian dinar is worth how much?
10 CDs.
10 cedis. So you can imagine. How did we get this? Because we hardly trade with Jordan. Do you understand what I'm trying to say?
Yeah.
Good. So these online platforms use what we call cross exchange rate. They use cross exchange rate. Just a minute. My mouse. Let me use. What is it here? Yeah, here. Yeah. You can see, right?
Yeah.
So the cross rate refers to the rate derived from two quotations with a common currency. Okay, the calculation of foreign exchange rate from two separate quotes that contain a common currency. For example, the value of the peso, Mexican peso, is 11 cents. The value of Canadian dollar is 70 cents. So these are two quotations. Okay?
Yeah.
In other words, I want to use a Ghanaian example to make it easy for some of us. Microsoft Word. So let me share this. We'll come back to this slide. We can all see, right?
Yes, sir.
Alt equal to, let me make it bigger. So we'll just use $1, $1 is equal to, where's the Ghana cedi symbol? Okay, let me just use this. Where Ghana cedi? I think it's somewhere here. Yes. Is equal to 8 cedis,
It is 15. That's
15 pesos. Then we have another quotation. Let's say the British pound. Let me check fidelity. What was the rate? Okay, we used ADB's rate, so let's use ADB again. British pound. The British pound is, let's say 10 cedis, 21 pesos. Can you still see my Microsoft Word?
Yes, sir.
Or you're seeing something different? You're still seeing it, right?
Yes.
Okay. Alt equal to, make it bigger. Make everything. Okay, so £1. I'm sure I can get the symbol for the pound here. British pound, British pound, British pound. Okay, so let's see. Letter like symbols. Okay,
I
then
think it's there.
is there, right?
Yeah.
Where I can't see.
Okay, it's not the one. That one.
It's not.
It's not
So let's check here. Sure. Yeah, so it's here. So one British pound is equal to 10 cedis, 21 pesos. So I'll just copy this, bring it here.
Okay.
So these are two quotations. Now, what is the exchange rate between the dollar and the pound? Okay, so you can use these two rates to derive the exchange rate between the dollar and the pound.
And the pound.
Do you get that?
Yeah.
So how do you do that? The easiest way is to find the indirect quotation. In other words, make the common currency the subject of both quotations.
Okay.
Do you get that?
Okay, sir.
So here we can write this. What will be the indirect quotation? We want to write it as 1 CD is equal to 1 CD is equal to what in dollars. Then here also we want to write it as 1 CD is equal to what in pounds.
Yeah. Okay.
So here, the first one will be what? Just 1 divided by 8
0.12.
So it's
0.12.
0.12. And then this one is what?
10.2. 0.01.
So
Okay, it should be 0.1.
0.1 what?
0.
Are you sure?
Yeah, it is 0.0979.
Mm-hmm. Okay, so I get you. So let's leave it that. Okay. Okay, let's leave it in 3 decimal places and let me see some. So is that 979?
Yeah.
And then this one is what?
No, that one is 0.0979.
The first one.
Yeah, this one, yeah, the pound.
The pound. Okay, what about the dollar?
That one is
Is what?
0.1226.
The 1 3. 1 2 3, right?
Yeah.
Good. So let's leave it this way. So now we have 2 quotations. Okay? Both of them, the CD.
Sir.
Yes.
Please, let's make the pound 0.09.
Why? What comes after the 9?
Okay, 0 comes first before the 9. Yeah.
Like this.
Yeah.
And what comes? So these values are correct.
Yeah.
Okay, so I'll turn this to 8, like this.
Okay.
All right. So we have these 2 to work with. And I'm sure from here it shouldn't be difficult for you. So if 1 CD is equal to this, and 1 CD is also equal to this, it means this one is equal to this. Do you get that?
Yeah.
If X is equal to Y, and X is also equal to Z, it means Y is equal to Z.
Yeah.
Yes.
Okay. So the pound is going to be equal to the dollar. This value.
Okay.
So from here, you can find the dollar or you can find the pound.
Okay.
True or false? Just treat them as variables. So make the pound the subject. So you're going to have the British pound being equal to
0.123 over.
so 0.123 divided by what? 0.09. And that should give you the price of the the British pound in dollars. Okay, remember this one is dollars. So what will you have?
We have 1.255.
So you have 1.255. Okay, so we can leave it that way. If you also want to have the price of the dollar Then the dollar is going to be equal to what? This figure, right? Divided by
0.125. 123.
1, 2, 3. 0.123. And that should give you what?
0.123. Hello.
Yes, go ahead.
0.7967.
7967.
Yeah.
Okay. So that is it. And these rates are called cross rates because they are derived from two quotations with a common currency. Are we all together?
Yes.
All right. Thank you. Then let's move back to the slides and see the example that we have. So you can see with this one, if you want to find the value of the pound, you see you are dividing this one by this. Okay. But if you want to find the dollar, you divide this by that. Okay. So this is the safest way to go. Okay. But that is not the only way. You can just divide the value of peso in dollar by the value of peso in Canadian dollar. So if you are looking for Canadian dollar, then the quotation for the Canadian dollar should be the denominator. If you are looking for the value of the value of peso, then the value of peso should be in the numerator. If you are looking for the value of Canadian dollar, then the value of Canadian dollar should be the numerator. And that. But the safest way to go is what I have just shown you. You don't have to worry about that if you don't know how to do this one. So the cross exchange rates are provided for several major currencies on Yahoo's website, Yahoo Finance, finance.yahoo.com/currency converter. So that is this understanding that is used to build the cross rates or the rates that you see. So the one Jordanian dinar is equal to the 10 cedis is derived from the relationship between the cedi and the dollar, then the Jordanian dinar and the dollar. Okay, so based on that, they'll be able to compute a cross rate for the currency of Jordan and the Ghana cedi. Good. So cross rates are important. It allows us to establish exchange rate between currencies of two countries that don't even trade at all and that don't even have an active foreign currency market for the respective currencies. Now, we've spoken about the spot market, but we also have the currency derivatives. Okay, what is a derivative? Who can tell me? Let me hide it small. What is a derivative?
Okay.
Yes, go ahead. A derivative is what? This is the last thing we'll do and we'll close. What is a derivative? Hey,
Okay.
accounting and finance students. Didn't you do financial markets and institutions?
Hello,
Yes.
sir. The
Yes.
agreement between two or more parties based on what they agreed on.
Hey, boss. Financial, yes, go ahead. Derivative.
It's clear the price of an asset is determined by an underlying asset.
The value is a contract whose value
Yes,
depends on the value
of an underlying
of an
asset.
underlying asset. Okay. So in the foreign currency market, for example, if I put on paper that and I write, if you get an A in international trade finance, I'll give you 1,000 cedis. Then I sign. You also sign, and I give that paper to you. The value of the paper depends on the grade you will get in the exams. If you don't get an A, the value of the paper is 0. Right? But if you get an A, the value of the paper is what? 1,000 cedis. So a derivative is a financial instrument whose value depends on the value of an underlying outcome. If it rains in Medina tomorrow, I'll give you 100 cedis to buy an umbrella. So, and I put it on paper. The value of that paper is dependent on the weather tomorrow. If it doesn't rain, the value of that paper is 0. If it rains, the value of the paper is what? 100 cedis. Now, you can trade these papers. For instance, I have that agreement with you. And then you tell somebody, I have an agreement with my lecturer that if I get an A, but I need money now. So why don't you buy this paper from me so that when I make the A and I take the 1,000 cedis, I'll give it to you. Or I'll even give the paper to you and you become the person who is entitled to receive the 1,000 cedis. So I will look at you. If I feel you can make the A, if I'm very confident you can make the A, then I'll buy the paper from you, but not at the 1,000 cedis, of course. Hoping that when you do finally make the A, I'll get 1,000 cedis and make a profit. But if I don't have confidence in you that you can get an A, okay, so I will not buy that paper from you, or I'll offer to buy it at 10 cedis. Okay, if you give it to me, fine. Then I'm willing to risk 10 cedis, even though I don't trust your chances of getting the A are very slim. So these are things that people do in the financial environment, and the paper becomes a tradable instrument. And that's why we call it a financial security, a financial instrument. It can be moved, it can be transferred from one person to another, that agreement. But the value of the paper depends on some underlying asset or activity. Now, bringing it to the currency market, we say is a contract with a price that is partially derived from the value of an underlying currency that it represents. And there are so many types. So we will do detailed explanation of this. Maybe I'll give you an assignment to cover that. Okay, the course is very broad, but we may not be able to cover all. So I'll give you an assignment later to cover currency derivatives. And the expectation is that you read on it and then do the assignment. But I know you won't read. So maybe in class, when we meet face to face, I'll form groups and I'll give some portions of that topic to you. You read and come and do 5 minutes presentation on them. And that will make it easy for us. And then we can continue our lecture on other topics. Forward contracts are examples of financial derivatives. Okay, and forward contracts are also used in the currency market. So it's an agreement between a foreign exchange dealer and a multinational corporation that specifies the currencies to be exchanged, the exchange rate, the amount to be exchanged, and the date at which the currency or the transaction will occur. A typical example. I have an agreement with Fidelity Bank, or let's say Nestle has an agreement with Fidelity Bank that they will buy the US dollar from them on 30th April 2022. And they're going to buy $1 million, and they are agreeing to buy it at 9 cedis per dollar. Then Fidelity and Nestle both sign to this document. It becomes a financial instrument. It becomes a forward contract. Okay. Now, on the 30th of April, if the exchange rate is more than 9 cedis, let's say it's 10 cedis, who loses?
Fidelity.
Fidelity loses because they could have sold it at 10 cedis, but because of the contract, they must sell at 9 cedis. But if on the 30th of April, the dollar is still less than 9 cedis, then Fidelity gains because they would have been selling it at lower than 9 cedis in the market, but because of the contract they signed, they are selling it at what? 9 cedis. Okay, so the value of the paper to each party or either party depends on what the spot rate is going to be on the 30th of April. So the value is derived from the spot rate on the date of execution of the transaction. And that's why we consider it as a derivative. It derives its value. Okay, if on the 30th of April, the price of the dollar is 9 cedis, the value of the contract to Fidelity is going to be minus 1 cedi because they are losing 1 cedi. So their return is going to be negative return. But if on the 30th, the value is 8 cedis, for instance, it means they are gaining 1 cedi and the return is going to be plus 1 cedi. So the value depends on the future spot rate. Now, the rate that is agreed in the contract is called the forward rate. Okay, the forward rate. And the market is called the forward market, where forward contracts are traded. You can trade it. So if Nestle signs that agreement, they can actually sell that contract to somebody else. And Fidelity can also sell their version to another person. Okay, so let's say they sell it to Bank A, NIB. So on the 30th of April, NIB becomes responsible for executing the transaction, for supplying the dollars. If Nestle also sells it to Guinness Ghana Limited, then Guinness will now become the organization responsible for buying the dollars from whoever holds the other part of the contract. So financial derivatives can be traded. Okay, they are transferable from one person to another. Then we also have the futures rates. Remember, the forward contracts are between two parties without a third party, and they are also not standardized. It can be any amount. Okay, the futures contracts are similar to the forward contracts, but they are sold on an organized exchange and regulated, and the amounts are usually standardized. For example, you cannot buy, let's say, $1,001, but maybe the standard could be in multiples of $1,000, $1,000, $2,000, $3,000. Okay, but not in other. So there's standardization in the futures contracts. And the rate at which the exchange is done is called the futures rate. The understanding is the same, but this one is standardized and is regulated. And you don't even need to know the other party that you are agreeing or entering into agreement with. The futures rate is the exchange rate at which one can purchase or sell a specified currency on a specified settlement date. Okay. So each value also depends on the future spot rate. And then we have options. For options, it is not an obligation on one party, but it is an obligation on the other party. There are two types of options. We have the call option and then we have the put option. The call option gives the holder of the contract the right to buy. Okay. So if there's an option, a call option, if Fidelity, or let me say Nestle has a call option on Fidelity, on the date, the future date, Nestle can go to Fidelity and say, we want to execute the contract. We want to buy the dollars from you. But if the future spot rate is better than what they agreed, then they may not exercise their right. We often say that they will not strike. But if the future spot rate is higher than the agreed rate, what we call the strike price, they will strike because they are going to get it at a lower price from Fidelity. And Fidelity will have no option. It is Nestle that has the option. And because Nestle has the option to call on Fidelity on the date, and Fidelity doesn't have an option, Nestle, you would usually pay what we call a premium. Okay, the options premium. They will have to pay a premium to Fidelity for agreeing to bear the risk. But we also have what we call the put option. So in this case, the seller has the right to sell, but they can decide not to sell. Okay, so if Fidelity has the put option, they will put the dollars on Nestle, and whether they like or not, they will buy. So in this case, with the put option, the Fidelity will have to pay a premium to Nestle in that case. So these are the two types of options. We have the call option and then the put option. Good. So I want you to go and read on the money market. Also read on the credit market is here. And then also read on the bonds market is here. And I also want you to read the stock market. It's also here. They are very easy to understand. In fact, we've covered most of these things in corporate finance. And I don't think it should be a problem for you. Financial markets serve multinational corporations in so many ways. Foreign trade with business clients and finance. Okay, if you want to do business with foreign clients, you need foreign currency. And the international financial markets will serve you. If you want to make foreign direct investment, you will need foreign currency. You may even need to borrow money in foreign currencies, and the international financial markets will serve you. If you want to make short-term investments or financing in foreign securities, the financial markets will also serve even long-term transactions. Good. Any questions? If there are no questions, then we end it. Then we have discussion questions also too. Any questions? Andy, sorry, Ashley, Susanna. Ask your question.
Okay. Please, in the case.
Hey, network.